The only trading indicator strategy you'll ever need, 3-step filter system. Intro: never use an indicator until you understand this truth. It's not that you're using the wrong indicator. It's that from the very beginning, you were never taught how to think about it correctly. Let's start with a simple question. Are you using technical indicators to make buy-sell decisions? If your answer is yes, then the next question might send chills down your spine. Do you really understand what that indicator is telling you? Or are you just reacting to arrows, colors, and blinking signals on a chart? Most retail investors, from beginners to those with a few years of experience, share a dangerous trait. They know indicators, but they don't understand the essence behind them. And it's not their fault, because rarely has anyone ever taught you what's called how to use indicators to understand market psychology, not to catch bottoms or tops. Indicators are mirrors, not compasses. Imagine you're driving through thick fog. You have 3 tools. Rear view mirror looks into the past. Dashcam records every movement. GPS shows direction. In the trading world, most indicators are rear view mirrors. They reflect what has happened, then translate it into signals. RSI, MACD, THMI, they all look backward, not forward. And if you use a rear view mirror as a GPS, you'll drive off a cliff before you know it. The real problem isn't using the wrong indicator, it's using it with the wrong purpose. Many people open RSI, see it below 30, and think, oh, oversold, time to buy. Or they see MACD crossing above the signal line and shout, bullish, enter now. MA20 crosses above MA50? Trend confirmed. But the question is, do you understand why RSI dropped to 30? Who pushed it there? And is that force weakening or growing stronger? MACD crossed because volume increased or just a delayed reaction to price? MA's crossed. Is that a sign of big money flow or just random noise? If you don't ask those questions, you're not investing, you're gambling with tools. We need a new way of thinking about indicators. Not how to use RSI to catch the bottom, but what is RSI telling me about the current market psychology? Not what time frame is best for MACD, but does MACD help me understand who's in control, individuals or institutions? Not which MA confirms the trend, but how does MA reflect the crowd's confidence velocity? And in this video, I'll unlock that mindset. This video won't just show how to use RSI, strategies with MACD, or which MA works best. I'll show you how to read the market's emotions through RSI, something almost no one talks about. How to use MACD as a truth scanner for hidden money flows. And why only by understanding the crowd's belief velocity through MA can you know which trend is real and which one is a trap. Why do most people fail with indicators? Because they study indicators like math formulas, not like storytellers. Because they chase buy-sell signals, instead of understanding the psychology behind the chart. Because they think trading is technical, when in reality, it's mass psychology encrypted in price action. In the next 3 parts, I'll uncover these truths. Are you ready? Part 1. RSI is not for catching bottoms. It's for hearing the heartbeat of the crowd. Part 2. MACD is not for trend confirmation. It's for exposing the hidden motives of big money. Part 3. MA is not for defining trend. It's for tracking how quickly trust spreads in a stock. And if you stay until the end, I'll share a principle to test market psychology using these 3 indicators in just 5 minutes each morning. No complex signals. No coding. No dependency on fancy indicators. Just the right mindset, and you'll see the market unfold like a living story. Hit subscribe and get ready to enter the real digital world, where indicators are no longer just signals, but the whispering voice of the market. Because real moneymakers don't need more indicators. They need the right perspective. Part 1. As if the heartbeat of the crowd. RSI, Relative Strength Index, one of the most widely used indicators. But most investors treat RSI as a simplistic rule. Above 70, overbought. Below 30, oversold. They see RSI below 30 and rush to buy. See it above 70 and rush to sell. That approach is a formula for long-term losses. 1. RSI is not a signal, it's emotion encoded. Let's be clear. RSI does not predict the market. It measures the strength and durability of a price trend over time. Think of RSI like measuring the market's heartbeat. When RSI spikes, it's like a racing heartbeat, excitement. When RSI drops, it's a slowing beat, fatigue, maybe even collapse. It doesn't tell you the market will reverse. It tells you the market is in an emotional extreme. 2. Don't buy when RSI drops below 30 unless you know this. RSI below 30 is often called oversold. But no one tells you this. Some stocks stay under RSI 30 for over 2 months and keep falling 30 to 50% afterward. Because RSI doesn't work in isolation. It reflects recent price momentum. If prices drop sharply, RSI naturally plunges. But if volume is still high, prices keep closing lower each day. That's a sign of real panic in the market. In such cases, RSI under 30 isn't a buy zone, it's a danger zone. 3. Low RSI isn't a buy signal, it's a trigger to observe reactions. When RSI enters oversold territory, if volume decreases, price starts to stabilize, RSI rises slightly even though price hasn't, that's a positive reaction. Sellers are drying up, buyers are stepping in. If volume stays high, prices continue breaking lows, RSI goes flat or drops deeper, that's widespread panic. You shouldn't enter. The secret isn't the RSI number, it's how the market reacts after RSI hits that number. 4. High RSI should be read with psychology, not formulas. When RSI greater than 70, many traders rush to take profits. But in reality, strong stocks with RSI greater than 70 can still surge another 30 to 40%. Because in truly strong markets, RSI can stay high for a long time. If RSI rises with strong volume and price makes higher highs, that's a sign of sustainable strength. Don't sell just because RSI crossed 70. Be cautious only when RSI greater than 70 but volume is declining. RSI makes lower highs. Price moves sideways or weakens. Price breaks new highs but RSI doesn't. Bearish divergence. That's when RSI is warning. The crowd is excited but running out of steam. 5. RSI plus price behavior equals a more accurate reading of the heartbeat. Here's how to read RSI more effectively. Scenario interpretation action. RSI less than 30, price hits new lows, high volume real panic, not over yet observe, don't enter. RSI less than 30, price holds support, volume drops selling pressure easing, base forming watch closely, consider early entry on confirmation candle. RSI rising while price goes sideways silent accumulation, potential breakout try a small position. RSI greater than 70, strong volume, price makes new highs healthy market, trend intact hold position, raise stop loss. RSI greater than 70, weak volume, RSI doesn't break old highs weak momentum, possible top be alert, consider exiting. 6. RSI plus price action plus volume equals the trio for reading crowd emotion. When you don't use RSI alone but combine it with price and volume, it becomes like RSI, the heartbeat, price, body movement, volume, breathing. And when these three are out of sync, it means the market body is under stress. 7. The biggest mistake, using RSI to decide instead of to listen. RSI is not a tool for immediate action. It's a tool to help you know when the market is emotionally extreme. Recognize zones where you should wait, not jump in. Differentiate a true trend from a fake bounce. Most losses happen when traders see RSI drop and think, this is an opportunity. But in truth, it's just a sign that the market is having a heart attack. In summary, RSI isn't a red/green light, it's the heartbeat of the market. Learn to listen to it, not just read the number. In part 2, we'll dive into another widely used yet easily misunderstood indicator, MACD. Many believe it confirms trends, but it often just tells you what already happened. I'll show you how to transform MACD into a smart money detector, something most people never tell you. Are you ready? Part 2. The Money Flow Detector. MACD, Moving Average Convergence Divergence, is one of the brightest technical indicators on the chart. But did you know? 95% of investors use MACD like a rearview mirror, while professional traders use it like a money flow radar. The difference isn't in the MACD line crossing the signal line. It lies in understanding what doesn't appear on the chart. 1. MACD is not just a trend indicator, it's an emotional map behind the price. MACD is essentially the distance between two EMAs. EMA 12, fast, and EMA 26, slow. When MACD crosses above signal, usually seen as a buy signal. When MACD crosses below signal, seen as a sell signal. If you buy right after MACD crosses up, you're already acting after others have. Because MACD reacts after price. Price has already risen before MACD crosses up. When you buy, the smart money has already entered several sessions earlier. In other words, MACD doesn't predict trends, it confirms emotions that have already occurred. 2. Don't be fooled by MACD crosses up equals buy. Many market traps look like this. MACD just crosses up, you buy. Immediately, price reverses and drops hard. You panic, cut losses, and then see the price bounce back. But because indicators lack context, MACD only matters when the market has accumulated long enough. Volume is showing signs of increase. Price breaks a clear resistance. If MACD crosses up in a sideways zone with low volume, that's the perfect bull trap. 3. How to read MACD like a pro. Focus on strength and width. To use MACD as a money flow detector, pay attention to factor meaning. Widening gap between MACD and signal buying pressure increasing, new money flowing in. MACD rising but histogram weakening, buying momentum fading, risk of distribution. MACD rising but histogram narrowing, strength is losing sustainability. MACD rising, histogram steadily growing, volume increasing, strong, reliable money inflow. In short, MACD tells you about the engine behind a price rally. Is it real or just crowd behavior? 4. Max strongest signal when no one's watching. You'll be surprised, but the most powerful MACD signals often happen when the stock has been accumulating for a long time. Price moves sideways, low volatility. Volume dries up, no one's paying attention. Then suddenly, MACD begins to rise. Histogram shifts from negative to positive. That's when smart money quietly steps in. Imagine, MACD is like a stethoscope. Histogram is the heartbeat. When the histogram suddenly surges after a period of silence, it's an irregular heartbeat. Equals something big is about to happen. 5. The formula to identify a real breakout with MACD. Here's how professionals spot true breakouts. Step 1. Watch for price accumulation 3 weeks. Stock moves sideways, no big waves, low volume. Step 2. MACD histogram shifts from negative to positive. Early signal of money flowing in. Step 3. Price breaks resistance, volume surges. MACD crosses above zero, histogram spikes. Equals, this is a breakout supported by smart money. This signal is rare, but extremely powerful when it appears. 6. The biggest mistake, using MACD as the only buy signal. Many investors make this mistake. See MACD crossing up equals buy, without checking market context. No base analysis, no volume observation. Result, buy at the top of a rebound. Then when MACD reverses, cut loss, only to see the price bounce again. That's the tragedy of using MACD without understanding the psychology behind it. 7. MACD combined with volume and price action reveals money flow intentions. Situation interpretation action. MACD crosses up, histogram grows, high volume, price breaks base, strong money inflow, true breakout, enter with high probability. MACD rising, but histogram weakening, low volume uptrend losing strength, risk of distribution, watch, no entry. MACD crosses down, histogram drops sharply, sudden volume spike selling off, money exiting cut loss or exit. MACD crosses up while price is flat. Histogram slowly rises, quiet money inflow starting. Watch closely, opportunity may form. 8. Remember, MACD doesn't tell you what to do. It tells you what to understand. Don't use MACD to act. Use it to listen to the heartbeat of money flow. Coming up in part 3, we'll explore a simple indicator that becomes extremely dangerous when misused: Bollinger Bands. This is the indicator that misleads thousands of traders into thinking band expansion means breakout. But in reality, if you don't understand it well, you'll fall straight into the trap set by market makers. I'll reveal to you how Bollinger Bands actually expose institutional intentions, something rarely taught the right way. Are you ready? Part 3: Bollinger Bands, the tension trap and the footprints of market makers. Have you ever heard these? Bollinger Bands expanding is a breakout signal. When price touches the lower band, it's oversold. Time to buy. But then, you buy when price touches the lower band, it keeps falling. You sell when price touches the upper band, it keeps rising. You enter when the bands expand, price reverses. What's really going on? 1. Bollinger Bands are not buy signals. They're traps. Bollinger Bands consist of 3 components. 20-period moving average, MA20. Upper band equals MA20 plus 2 standard deviations. Lower band equals MA20, 2 standard deviations. Usually people say, price hits upper band overbought. Price hits lower band oversold. But markets don't follow formulas. They follow emotions and the intentions of big money. 2. The trap called band expansion equals breakout. You've seen this. After a tight squeeze, the Bollinger Bands expand. You think, it's about to explode. Time to enter. As soon as you enter, price reverses. The bands still look wide and you think, maybe I was just early. Reality: band expansion doesn't tell you the direction. It only says, volatility is increasing. The direction is decided by the big players, not the bands. 3. Market makers use Bollinger Bands to trick you. A familiar scene. After a period of accumulation, price suddenly jumps. Bands widen, candle breaks through the upper band. Volume spikes. The perfect breakout signal, right? Wrong. That's a false breakout, crafted to lure retail traders in. Create liquidity so big players can dump their positions. How to spot a false breakout using Bollinger Bands. Price surges but volume fades after breakout. Breakout candles have long wicks or get pushed back. Price reverses within 1 to 2 sessions. 4. The real power of Bollinger Bands, when they go silent. Surprisingly, Bollinger silence is when you should pay attention. A tight squeeze usually signals a big move is coming, but not every squeeze leads to a breakout. A real breakout only happens when 3 conditions align: extremely tight bands, very low standard deviation, dry up in volume, no interest, calm before the storm. Sudden surge in volume with a breakout candle that closes above the band. When this happens, The smart money has finished accumulating and is ready to move the price. 5. How to read market makers' footprints with Bollinger Bands. Watch for these patterns. Patterns signal market makers' intent. Fake breakout price breaks upper band, long wick, low volume lure retail buyers, prepare to sell. Squeeze plus volume surge tight bands, sudden breakout with high volume accumulation complete, time to pump. Riding upper band price hugs upper band for days, MA20 slopes up strong momentum, safe to ride trend. Break below lower band plus low volume mild shakeout, not a real distribution, watch carefully, may rebound. 6. Classic trap, bands expand, you enter, institutions exit. You see the bands widen, price explodes upward, you jump in. But the stock had already rallied 15 to 20% before. Volume is extremely high, everyone already knows. That's when institutions create a magnet candle to attract your money. Slowly unload while price stays flat or slightly up. By the time you realize it, it's already too late. 7. The right Bollinger strategy. Step 1. Look for band squeeze in a tight base. MA20 is flat. Price stays in a narrow range for 5 to 10 sessions. Volume dries up. Step 2. Wait for the first breakout candle with high volume. Price breaks out of the band. Candle closes strong with no upper wick. Volume is 1.5, 2x higher than average. Step 3. Monitor next 2 to 3 sessions. If price holds above the band and volume stabilizes, that's your ideal entry. 8. Bollinger Bands plus volume plus candles equals real versus fake breakouts. Signal interpretation action. Bands widen, price pops, volume drops, fake breakout, stay away. Tight bands plus breakout with rising volume, real breakout, enter. Price hugs upper band for 5+ days. MA20 slopes up, strong uptrend, hold position. Price touches lower band. MA20 slopes down, strong downtrend, don't catch falling knives. 9. Remember, Bollinger Bands reflect emotion, not direction. Explosive moves up or down aren't caused by expanding bands. They happen because energy has been accumulated beforehand. Bands are just the outer shell. You need to look inside. Price action history. Money flow. Market psychology. Coming next. When all indicators conflict, what should you trust? You've seen RSI, MACD, Bollinger Bands, but sometimes RSI says oversold, but price keeps falling. MACD gives a buy signal, but price doesn't move. Bollinger Bands expand, but price stalls. Which indicator should you trust? Or should you ignore them all and look at something else? Part 4. The final secret. When indicators conflict, look at the market maker's footprints. They reveal everything. This is the key that few ever teach you properly, and it's the most important part of the entire series. Want to unlock part 4? Message me and I'll show you the truth. Part 4. When all indicators conflict, what should you trust? How do you feel when you're facing a series of conflicting technical indicators? RSI shows overbought signals, but the price keeps rising. MACD signals a buy, but the price continues to fall. Bollinger Bands expand, yet the price doesn't break out as expected. Sometimes, indicators give you signals that go completely against what you feel from the market. How can you trade when all the signals contradict each other? 1. Don't rely on a single indicator, combine tools. One of the biggest mistakes traders make is relying too heavily on a single indicator. RSI, MACD, Bollinger Bands, they are just tools, not final decisions. When indicators conflict, you can't base your decision on just one. You need to combine multiple indicators to get the full picture. For example, RSI might show whether the market is overbought or oversold, but you need MACD to confirm the trend direction. Bollinger Bands might suggest potential volatility, but you need volume to verify the strength behind it. 2. Institutional footprints. What indicators can't show? Sure, technical indicators provide valuable data, but you'll miss critical insights if you focus only on numbers and charts. Institutional footprints, or the footprints of smart money, are what you need to watch for. Think of large institutions as sharks in the market. When they move, they leave traces. High volume as price starts to change. Sudden price movements without clear reasons. Strong candles with large volume that don't move in the expected direction. These signs show that big money is manipulating the market. You must follow their actions, not just your indicators. 3. Identify real trends with price patterns. If you've heard of patterns like head and shoulders, double tops, or triangles, you'll know they can indicate true market trends that indicators might not reveal. Price patterns are powerful tools for spotting trends that indicators often miss. But they can also fail if not confirmed with other factors. How to tell real patterns from false ones? Volume must support the pattern. A strong pattern has large volume at breakout. The pattern's location in the trend matters. Patterns that form within a confirmed trend are stronger. For market sentiment, the invisible force behind every indicator. One thing indicators can't measure is market sentiment. Market sentiment is what's going on in traders' minds. They're scared, greedy, confused, making decisions based on emotion, not logic. This creates unexpected market moves that render technical indicators unreliable in key moments. So when the market is unstable, focus on price action, not just signals. Crowd emotion can cause fake oversold or overbought signals that no indicator can detect. 5. No indicator is perfect. Always remember, no indicator is perfect. Each has its limitations and flaws. That's why combining tools and viewing the market holistically is essential. When all indicators conflict, you must look at the big picture, build a long-term strategy, analyze the overall market. Read price action, observe candlestick patterns, price moves, and money flow. Listen to the market. Even with conflicting indicators, the market always tells the truth through its behavior. 6. Conclusion. Learn to read the market from subtle signs. No indicator can replace your ability to observe and feel the market. Indicators are tools, but to become a successful trader, you must develop the skill to read institutional moves and market sentiment. And always remember, consistency and patience are the keys to success. Nothing is instant. Nothing is easy. When you learn to read the market and separate real from fake signals, you'll always be one step ahead. Next part, the final key to winning the market. Are you ready to uncover it? Part 5. The final key, what no one tells you about technical indicators. Most new traders, and even those who've been trading for years, believe the secret lies in finding the right indicator. They constantly switch tools, searching for a holy grail indicator that can give perfect buy and sell signals. But the truth is, you don't need another new indicator. You need to learn how to properly understand the ones you already have. 1. The market is a living organism, not a mathematical formula. Technical indicators are born from mathematics. They simulate market behavior using numbers, averages, and oscillations. But the market is not a math problem. It's a living organism, created by millions of people driven by emotions, fear, and greed. You can use formulas to grasp certain parts, but you'll never fully define the market with indicators alone. So, when your indicators don't react as expected, don't be quick to assume the market is wrong. Check how you're using them. When RSI signals overbought but price keeps rising, it's the large capital inflow pushing the price, not a faulty indicator. When MACD crosses over but the price doesn't move as predicted, it's because market psychology hasn't shifted the way you thought. 2. The most effective indicators are the ones you understand best. You don't need to master 20 indicators. Just 2 to 3 tools that you deeply understand, how they work, their limitations, and the right context, and you'll be ahead of 90% of market participants. For example, RSI. If you know RSI doesn't just show overbought/oversold zones but also reflects momentum and the strength of buyers versus sellers, you won't sell just because RSI hits 70. MACD. If you understand the delay between MACD and the signal line, you'll learn to read price shifts before the signal shows up. Bollinger Bands. If you realize that tight bands often precede strong breakouts, you'll prepare mentally instead of waiting for a clear market signal. 3. The real secret. Indicators don't make decisions, you do. Have you noticed? The same indicator can produce completely opposite results for 2 different people. One person can use RSI with great success, while another loses money using MACD. That's because not every tool fits every trader. You need to develop a trading style that fits your psychology, habits, and financial goals. And indicators should support your personal discipline and strategy, not replace your independent thinking. 4. Try this. Turn indicators into trusted companions. Next time you open a chart, don't rush to activate a bunch of indicators. Instead, try this. Use just one indicator. Watch the market for 2 weeks without placing trades. Simply observe how that tool reacts to price behavior. Take notes on when it works well and when it gives false signals. Compare what you see with price action and volume. When you start to feel like you're understanding the indicator, not just reading it, you've reached a higher level. The level of a trader who thinks. 5. A special gift just for you at the end. If you've made it this far, you deserve a reward. A simple yet powerful formula that can help you avoid more than 80% of false signals from technical indicators. This is something very few people talk about. They keep it to themselves or sell it in high-priced courses. And I'll share it with you in the final part of this video, not just a formula, but a method to combine technical indicators, price behavior, and market psychology into a real-world trading system. Final part, the truth behind technical indicators. A strategy no one teaches you. Don't miss it. You're almost at the finish line, where you'll understand why some people win using indicators, while others lose using the exact same ones. The truth is coming up next. Part 6. Indicator Combination Formula, a real-world trading system few share. We've gone through every layer of understanding, uncovering common mistakes, exploring the nature of indicators, and learning how to turn tools into weapons tailored to ourselves. Now it's time to share something you won't easily find in any free online course. A simple yet powerful combination strategy distilled from real trading experience. 1. The 3-layer filter rule. Never place a trade based on a single signal. The market doesn't work that way. Use these 3 filter layers to verify any signal you see. Layer 1. Trend confirmation. Use moving averages MA50 and MA200 to identify the primary trend. If MA50 is above MA200, prioritize long positions. If MA50 is below MA200, prioritize short positions. This is your market context. Don't trade against the trend. Layer 2. Momentum signal. Use RSI or MACD to gauge current momentum. RSI rising from below 30 could signal bullish momentum. MACD crossing above the signal line confirms buying strength. If momentum aligns with the larger trend, you've got a second layer of confirmation. Layer 3. Price action. Rely on candlestick patterns, support/resistance zones, or real breakouts. Bullish engulfing at support confirms a buying opportunity. Doji or pin bar after breakout warns of false moves. This final layer helps you read the real psychology behind price movements. Only when all 3 layers confirm should you consider entering a trade. This helps filter out over 80% of false signals. 2. How to combine indicators without psychological overload. Many traders fall into paralysis by analysis, overwhelmed by too many indicators giving conflicting signals, leading to hesitation and inaction. To avoid this, choose one trend indicator, like MA or super trend. Choose one momentum indicator, like RSI or MACD. Combine with price behavior, candlesticks, zones, or volume. Never stack 2 to 3 indicators of the same type, for example, RSI plus stochastic plus CCI, because they often give overlapping signals that can conflict and cause confusion. 3. Hard-earned lessons from real traders. The trader once told me, "It took me 3 years to learn how to remove indicators." He used to run 6 indicators at once, entering trades based on chaotic signals, and lost over 70% of his account. Later, he kept only 1 MA, 1 RSI, and 1 candlestick pattern. Since then, his profits became consistent. What impressed me wasn't the tools he chose, but the discipline and simplicity. It's not about which indicator is best, but how you use it to serve your strategy. 4. Sample strategy, the verified breakout. Here's a specific example you can apply starting today. Price moves sideways in a 7 to 10 session accumulation range. Volume begins to increase slightly. MA20 is below price, but MA200 is flat. Entry signals. RSI is around 50 to 55 and trending upward. MACD is preparing to cross upward. Breakout candle pushes above resistance with volume 2 to 3 times higher than average. Confirmation. The next two candles stay above the breakout level. No strong reversal candles appear. Plan. Enter long if price retests and holds the breakout zone. Stop loss 2% below the recent low. Take profit at a 2 to 1 R ratio or when RSI breaks 70 with divergence. See? No complexity, just one price pattern, two indicators, and a clear plan. 5. Final note. The sharpest indicator is your mind. In the end, remember this. Technical indicators aren't your compass, they're your map. You are the driver. If you have sharp thinking, discipline, and a strong mindset, any tool can become a weapon. And if today's insights were helpful, don't forget to subscribe to Bold Steps Forward to not miss deeper trading breakdowns. Comment your current questions about indicators. I'll cover them in upcoming videos. Share this video with anyone struggling with RSI, MACD, or Bollinger Bands and still searching for clarity. Keep taking bold steps. The right mindset is the most profitable investment of all.